Three, two, one.
Hello, everybody, and welcome back to the Dash Trader Newsroom. The big question on Monday was, is this the start of a midsummer meltdown? And by Friday, it certainly doesn't look that way. And as always, my name is Michael DeGioia. I'm the Director of Educational Services and a licensed professional trader here at Dash Trader. And let's jump right in and talk a little bit about Netflix's big miss. Netflix had a pretty substantial miss. Is this going to be predictive to the other big names that will be releasing their results soon? I think that the big miss for Netflix is more that everybody has kind of recovered from the pandemic expectations. The Netflix can no longer rely on the expectations that they're going to have, extraordinary subscriber growth. And it's kind of like a hangover, right? It's like the hangover for Netflix is that after this fantastic period of growth during the pandemic, people are watching less TV and they are getting out and living life again, mingling with their friends. And that is a very big part of the recovery. And Netflix certainly benefited from everybody staying at home and all the lockdowns and all the stay-at-home orders. But now that things are kind of going back to normal or more normal, certainly Netflix does not expect to continue to add subscribers at the rate that analysts had started to get used to. And so subscriber growth is going back to normalcy, and that may affect some other industries. So let's jump into what earnings do we have to look forward to next week. We have Tesla. We're going to, of course, take a look at these charts in a little bit. We have Tesla. We have Google. We have Amazon. We have Apple. We have Exxon Mobil. We have Pfizer, right, as in the vaccine. We have Facebook. We have, of course, McDonald's, a Big Mac attack. We have Caterpillar. We have Ford Motor Corporation. And, of course, we have Boeing. So for me, this is like the heart of earnings season. I believe we also have, Microsoft is coming up as well. Very, very big in cloud computing. A lot of people look at that might be the following week, but certainly it's coming up soon. And the big question for everybody is whether or not earnings expectations and valuations will start to matter again. And on Monday, it was really, it was a brutal day on Monday on Wall Street. The markets gapped down, new fears about the pandemic. And that brings me to the final topic of the news today, which is, will the Delta variant and other variants continue to slow down the recovery, and what is their effect on the supply chain, and will it cause inflation? In terms of why we sold off on Monday, we saw the reinstitution of lockdowns in a couple of places. Certainly 50% of Australia is locked down. We had the impending start to the first Summer Olympics with no spectators. We have lockdowns going on really across Asia, which seems to be the epicenter now. We have places like Indonesia. Bali was just getting back on its feet. It's locked down. A lot of places in certainly Vietnam is locked down. So we have this very, very big increase in lockdowns, specifically in Asia. We had a couple of places, even in Israel, adding some new restrictions. And Israel is one of the places that was largely vaccinated. And at the same time, we have England loosening restrictions, and the United States pretty much done with all of its restrictions. So there was a very big wave of fear that lockdowns were going to slow down the economy. And I think by Tuesday, the reaction was, oh my God, lockdowns slow down the economy, more stimulus. And the Fed will keep buying bad assets, keep quantitative easing going. And the market now responds to the Fed. It does not really respond to the normal market forces. And this is why we ask the question, will earnings and expectations and valuations start to matter again? Because certainly it is a possibility that earnings and earnings expectations and valuations will certainly have to play a key role in stocks going forward. But right now, we're still kind of on this government stimulus is what the market is reacting to. And if it looks like we're going to have a slower recovery and we're going to have a continuation of this global slowdown and continued interruptions in the supply chain, that means that the Fed money prints and the other central banks around the world are going to have to continue to print money. And I believe that that was the reason why the market shrugged off the sell-off of Monday. The buy the dip people came in, and the market surged up to all-time highs. And that's kind of the rationale, that the only rationale that I could think of that explained the market's reaction to the really pretty bad news going around the world as the continuation of the various variants have taken hold, et cetera. So on that note, I'm going to jump to the charts. And I'm going to just bring up my screen here. I have a lot of charts to go through. And actually, let me just do this first before I go to the charts. I want to have my slide up here with all of my various different earning stocks. Let me just switch screens. Hopefully everybody can see my screen here. And so let's take a look first at Tesla, because Tesla has its earnings after the bell on Monday. Let's take a look at Tesla. I mean, if you look at the Tesla daily chart, really not very impressive. I mean, it does look like it's scrunching to blast off. It's kind of come way off of its highs. Just stretch this out a little bit more, give us a little bit more chart screen. Jumping into my Dash Trader charts here. And let's take a look at Tesla. This is the weekly chart of Tesla. I mean, if I looked at this and if I snapped on and used some of my technical tools, here is my trend line raise. I mean, this looks like almost a perfect breakout pennant. I mean, it looks like a wedge that's consolidating. And then here, the reason I say breakout is because if this was the low and I put in that low, I'm just going to make this one line a little thicker. Increase my trend lines to 5. Make this one red. Actually make it green. Okay. Green. And let's bump this up to 5. Okay. So you could see that we have really this kind of downward resistance on Tesla. If Tesla has any good earnings, and certainly, I mean, they've disrupted the entire auto industry. Everybody's making electric cars, and Elon Musk recently came out saying that Tesla, its hopes is not to be just a car company, but to be an innovative technology company across the board. But certainly Tesla looks like it is forming a wedge type pattern going into its earnings, setting up for a potential breakout opportunity. Next one I'm going to take a look at is Goog. And, the one thing I will say, I mean, look at this chart. I mean, it is just like up, up and away. We are taking off. And, if I zoom back a little bit, this was the March lows. This was Google breaking out of resistance there from the March lows. So there's the breakout. I mean, it really broke out around November, December. And I mean, there was no looking back all year. I mean, Google just went from 1750 up 1,000 points, or around 33%. Earnings growth has been tremendous for Twitter. And I'm just going to take a quick look at Twitter. Let's see if I can, TWTR. So Twitter already had their earnings. So Twitter is in the online advertising space. They had great earnings. They gapped up. We take a look at Snap, right? I mean, look at Snapchat. Snapchat really did a great job of reaching out to its younger client base and adding a lot of advertising and revenue generating tools, as well as a bunch of filters which added users. So here was Snapchat with a real beautiful breakaway gap and go from $63 to $74 and then blast off. I mean, let's take a look at the weekly chart of Snapchat. I mean, really from the March lows, big blast off in Snapchat when it broke above $24, $26. And then from there, it has literally tripled with a big blast off here. So my expectation for Google is going to be good. Let's see Facebook. I mean, Facebook has been really, lawsuits, antitrust cases, hearings on Congress. Nothing seems to stop Facebook. So we've talked about Tesla looking good, Google looking good, now Facebook, ad revenue growth. I mean, the only thing that could potentially hurt Facebook is that they have additional competition, but more than likely, revenues are going to be great. They've already broken away and gapped, obviously. So Facebook, looking great. Another one is we have Facebook, we have Amazon, and that Facebook app, I believe, was on the Twitter and Snapchat. So here's Amazon. Certainly, let's take a look at Amazon's weekly chart. Amazon, this is a very, very typical stair-stepping pattern, right? So you could see that the lows are ascending. Right here, lows are ascending. Lows are ascending. Right, so here is the breakout. The breakout has already occurred. And we should probably just, if I were to measure this move and just project it up, I mean, Amazon could really break or test the 4,000 mark. So, I mean, the tone has been set for these companies. Let's take a look at something that's not in that sector, something in the traditional sector or in the pandemic sector, PFE. I mean, PFE already looks like it's breaking out. I mean, this range on PFE is about as old can be. And I mean, pretty much, PFE has been pressing against the high here. They should have excellent earnings, obviously, with all the vaccine sales, et cetera. They are going into earnings next week. PFE setting up to potentially break out of its all-time or very, very long time, not all time, but certainly a very long time. It has not broken and seen above $42. I mean, I remember 5 years ago trading PFE between $32 and $42. So certainly PFE potentially at a point that it could break out and move higher. Mickey D's having a Big Mac attack, possibly breaking out to all-time highs at 242. That's Mickey D's. These are all looking like they want to break higher. And usually before anything happens, I mean, going into earnings is a good reason for them to break higher. I mean, Boeing, a little bit of a different picture, but the chart looks good. I mean, if you look at the chart of Boeing, it's kind of recovered off of its recent lows and could potentially break out to the upside. So it looks like the earnings season so far, at least from a technical standpoint, is looking good. Now, one of our stocks that we had mentioned probably is not going to have probably had good earnings last quarter, but may not be as good going forward with a global slowdown. They might advise into the next quarter is Exxon Mobil. Exxon Mobil certainly has made a tremendous run up since the March, April lows. It did put in a nice double bottom, but certainly a global slowdown in demand would affect oil, oil companies pretty directly. We did Boeing. I think that pretty much wraps them up. The only one we have left is Ford. Ford Motor Company, I mean, doing great, so strong, solid, nice uptrend. Really not bad. I mean, they have been the most consistent automaker. There was some bad news today with GM, recalling the Bolt electric car, which put some pressure on Tesla. It's very, very different market, kind of a low cost electric car. But certainly they had a little bit of a 2 day down day, 2 down days because of the recall with Bolt. But certainly Ford, looking great from a chart perspective and going into their earnings next week. And I believe that because of all the shortages, car sales have continued to be brisk, but the shortages may hurt their earnings, right? There's a chip shortage, which has slowed down car production. There are also AMD is going into earnings, Advanced Micro Devices. Intel had earnings, and their earnings was one of the few bad ones. They were the only they're the largest semiconductor company in the world, and they lost market share. So that might be a good thing for AMD. Certainly, let's take a look at, and this is a split. This was Nvidia. Nvidia had a split, so it's now split adjusted price. So Nvidia also just, had a stock split. So, that's another semiconductor company. But again, not an earnings situation here. This was due to a stock split. But that pretty much wraps it up for our earnings expectations. So in terms of our technical charts, let's jump to that. Let's take a look at spiders. And let's go to the weekly chart on the spiders. Okay, the weekly chart on the spiders. I mean, we have kind of skyrocketed up. I want to draw this line in here. Let's just put in our horizontal line. I want to put in the end of the year. Where were we at the end of the year? So from a technical perspective, if this is the end of the year, all right, so that if that's the end of the year, I mean, there is a very strong possibility that if we start to react to normal valuations are very, very high. If we're going and start to rate companies on normal, traditional gauges and measures, it is very possible that if a sell-off starts, we have had no significant sell-off since the pandemic started, the pandemic lows of March. We have been straight shot up, right, in this kind of asset inflation. Some call it NOLA. I call it no other logical alternative. Some call it TINA. There is no alternative. So whether you call it NOLA or TINA, you can see that the market has pretty much been straight shot up. It's a little more so and more exacerbated on the tech side, where technology has just kind of gone higher. And if I put in my little indicator here on my chart, I mean, you can see that you're up about 15% on average on the S&P. If we do get a correction and we don't get the pullback bought, we could very, very easily fall back to the line that the market opened at the beginning of the year. And what I've noticed is when you see this, that you don't have these kind of multi-week corrections. So we've had in the past, we had 1 4-week correction, 1 3-week correction. We have not had any of those. We've up for 1, 2, 3, 4, 5, 6, 7 bars with 1 week down. So let's just say 8 bars. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I mean, we're getting into the area where a correction is very likely. We have only had a 1 week correction here. We had a 1 week correction there, 1 week correction there, 1 week correction there, and then we got a 3 week correction. Here we were up for 1, 2, 3, 4, 5, 6, 7 weeks, 3 week correction. So we are overdue for a multi-week correction on all indices. Let's take a look at the DIA. DIA certainly is if technology and the S&P correct, sometimes that will benefit the DIA. It looks like the DIA is trying to break out. It has not been making new highs as often lately as the Qs have and the spiders have. Certainly the situation with the Fed, the Delta variant, potentially, slowing down the Fed's stopping of stimulus, that helped technology, because technology benefits the most from low interest rates and the Fed's quantitative easing. So the DIA, if the Nasdaq starts to correct and we start to be concerned with interest rates and inflation, the DIA will probably benefit, and the Nasdaq and the S&P will, the Nasdaq being the most reactionary to it, and the S&P being somewhere in the middle, because it's kind of a blended average between the DIA, Nasdaq, and just more of a broad-based group of companies. So on that note, I'm going to jump back to my slides. Let's just take a look to, there's one more thing I did want to look at before I jump to my slides. GBTC, let's see, GBTC. So Bitcoin, which is represented on the equity markets as GBTC, has finally put in a green bar, and we might be getting a bounce in Bitcoin. So we do look like the correction might be slowing on Bitcoin, because it has not been moving up with the market. It's kind of been dead in the water. ETHE is Ethereum, which just has a wackadoo chart, GBTC. So let's just, Bitcoin might be finally have put in a bottom. GLD, certainly not going anywhere, as the equity market is still the place to be, but gold certainly putting in a higher low here, a low here, and then a higher low. So with those being covered, let's just jump to the slideshow and do our standard announcements. So for anybody who's been wondering, today we released our third of our newest 8-part series on styles of trading. Today's release was on swing trading. You can check that out on YouTube. Visit our Dash Trader Pro YouTube channel to view it. Stay up to date with all things DAS by signing up for our monthly newsletter and emails. Simply fill out the form at the bottom of our webpage. Subscribe to our YouTube channel, Dash Trader TV and Dash Trader Newsroom Reminders. You can follow us on social media, certainly on LinkedIn, Twitter, Facebook, and Instagram. And certainly hope to see you in some of our upcoming events. Everybody have a wonderful, wonderful weekend. Be cautious. Certainly markets don't only go up. We have been up and away over 15% already this year. We are coming into the midsummer doldrums, and certainly the 2 or 3 most bearish times of the year are September, October. August, September, October is one of the 3-month most bearish times of the year statistically. So just be mindful of that. Sometimes it is a good idea to just kind of, sell and wait it out and go to cash a little bit, or reduce some exposure, put some stops on, but be aware of that. And everybody have a great summer, and see you in 2 weeks. All the best.